fallen asleep yet, or are you still alive? Are you good? Amazing. Thanks for joining us this afternoon. The topic we're going to talk about now is tokenization and its potential to disrupt the entire financial services industry. It's a fascinating topic, and with me to discuss this today is a true luminary in this field. Chad Cascarilla, let me just give you a quick intro, is the founder and CEO of Paxos. Paxos is one of the biggest blockchain infrastructure players in the world. They work with major customers like PayPal, a number of crypto exchanges. They reach probably more than 10 million end users in the world, including me. I hold your products as well, proud to say it. And Charles, before founding Paxos, was working at Goldman Sachs, Bank of America, strong background in finance, and he started mining Bitcoin in 2010, which I'm sure all of us are kicking ourselves for not doing. Chad, a real pleasure. Good to see you.
Yeah, great to be here.
So I understand this is the first time you're in Dubai, first time in the UAE.
That's right, first time here.
So you arrived 2 days ago, and I'm always interested to ask people this. So what are your first impressions? What do you think of Dubai?
Well, I think my brain's just starting to function right now. We got in Sunday night late, and I've been really impressed with the enthusiasm, the energy. It's remarkable what Dubai has been able to carve out in 20 or 30 years that has taken other cities, centuries to be able to do. And not just Dubai, but the entire Emirates. It's really impressive. And you can see how there's a real opportunity for the Emirates to take advantage of what I think is a missed opportunity by some of the other financial centers to embrace crypto, to embrace blockchain, and really to embrace the opportunity that I think bringing smart regulation can enable within this space. Ultimately, financial centers are about creating the right infrastructure to allow markets to develop, and there is a real missing element of that in a lot of other markets that you are seeing really, I think, addressed here, and it's going to pull a lot of people from the space in. We're really prepared to move a significant piece of our business to this market, and I can understand why others are considering it as well.
Amazing, and we'd love to have you. So tell me, let's start off with the basics. Can you please define what is tokenization and why is it beneficial? Why would we do it?
Yeah, I mean, it's always important to make sure we have the right definitions. I don't think there should be anything opaque around what does tokenization mean. Basically, most assets sit on centralized databases. And the concept of tokenization is you can put an asset on a decentralized database. And the point of a decentralized database is that it allows an asset to be able to move autonomously from one person to another, peer-to-peer. Without needing an intermediary, the ledger is maintained by all the participants. So instead of a database that's maintained by one centralized source, is maintained by a whole group. And that's a really powerful possibility because physical assets, which everyone can understand, well, you can own that physically. You have money in your pocket, you have keys to your car, you have any type of thing that you can own physically, you get it. But anytime something is electronic, you're almost always using an intermediary. You can't own it yourself. No, there's no such thing as electronic money that it does not require a bank account, as an example. Or almost any other asset, stocks, bonds, et cetera. It requires intermediaries, even chains of intermediaries. And the whole point of a tokenization is that you can take an asset, put it into a blockchain, and be able to own it yourself in a way that doesn't require an intermediary.
Okay, amazing, great. So a recent report by Citi forecasted that up to $5 trillion of illiquid assets are going to be tokenized by 2030. Starting off with $2 trillion worth of debt, $1.5 trillion worth of real estate, and just under $1 trillion worth of VC and private equity. So I want you to comment on, which asset classes lend themselves to tokenization first. Is there a particular asset class, or is it easy to tokenize anything?
Well, you can certainly tokenize anything. The question is, will people adopt it? And in order for there to be adoption, you have to think about what the right adoption curve is, which makes sense. Right? What asset, in other words, is going to get tokenized first? And no one can truly say when it comes to these asset classes what's going to happen first. The clear asset class that has been tokenized, that there is product market fit and people want, is tokenized dollars, tokenized fiat currency. Stablecoins clearly have product market fit. Once you get outside of stablecoins, it starts to become a little bit more murky. The next largest asset that has been tokenized is gold. We have the largest tokenized gold product, but that is quite small compared to tokenized dollars. There's $130 billion of tokenized dollars in the world, or something thereabouts. The next largest token, which is gold, is about $500 million. That's ours. And maybe there's $1 billion of total gold that has been tokenized. That's quite small. And then after that, it gets even smaller. And I don't think it's because tokenization is not going to be a success. There's $700 trillion of assets in the world. We think all of them will end up being tokenized in one way or another. But how do you go from dollars to the rest of assets, as Citigroup was pointing out here? And you're really trying to solve a couple problems. Can you create more liquidity by being tokenized? Can you lower costs by being tokenized? And oftentimes, putting assets in a token form is about lowering costs, but it doesn't necessarily increase liquidity. I spent my career in financial markets. You can look at small cap stocks. They're listed on a stock exchange. All the shares are fungible. It might have $300 million of market cap, and there is a term, we call those roach motels. You can buy them, but you can't get out. There's no liquidity. Yet, why is that? It's not because everything isn't standardized, it is. It's just that you have small issuances. Putting it on an exchange didn't make it any more liquid necessarily than being a private company. But some of those types of things, hedge funds and private equity, are very expensive to maintain, to understand what's going on, to get a clear record of, and so you might share or lower expenses. And so I think that it's not expense savings that drives tokenization, it'll be liquidity that drives the initial adoption.
Okay.
That's where it's dollars, that's where it's gold. I think it could even be other fungible asset classes. When it stops being fungible, I think it becomes a longer-tailed adoption curve.
Okay, cool. So let's talk about like private equity, venture capital. Now let's imagine we tokenize venture capital, and let's compare that with the traditional way a private company lists and goes public via IPO. Now typically a private company will go IPO, they'll have a bunch of bankers and lawyers, bankers poring over their financial statements, doing valuations, and eventually they'll come up with a price that the market understands and accepts, right? If we tokenize private equity, how does the whole pricing and valuation thing work? If you're not going to have banks involved or any other intermediaries involved, how do you get valuation correct so that the public are able to buy at a price that makes sense?
Well, we're a private company. We deal with this all the time ourselves. You have a capitalization table, and you spend a lot of time trying to prove what is your capitalization, who owns what. You have it on a blockchain, you have a golden record. Well, that immediately starts to change expenses and really costs of really just keeping ledgers in sync. And then you can imagine once you have shares on, say, a blockchain, it becomes easier to then have them change hands. So you might have a little bit more liquidity, but you certainly have lower expenses. But you also create the transparency that allows you, as you move from maybe an early stage private company to a public company, to be able to do it so much more seamlessly. The process could look more evolutionary than the idea that you just go public and it's an enormous process. And we've seen examples, I think only a handful in the US, where companies have gone public by a direct listing, which is that they just start to float their shares. Well, if you have shares on a blockchain and they can start to freely move around in some defined way as a private company, then going public doesn't have to become such a process of price discovery that you can't understand what's going on. And it can happen very, very easily. Right now, going from a private company trying to get your shares onto an exchange is really cumbersome. So that's just one small example of how tokenization can really change capital formation. And that's the whole point of a financial system, which is how do you allow capital to move as freely and quickly as the real economy? How do you facilitate the real economy? That's what you need. Why does tokenization need to exist? Well, everyone talks about Web3. To me, Web3 is something relatively simple. It's more digital, it's more global, it's more real time. That's actually the opposite of how the financial system is today. And that's because the financial system is a private closed network. Private closed networks innovate an order of magnitude slower than open public systems. And the information in open public systems, which is Web 2, is moving so fast and it's moving into a Web3 world, how is the financial system going to keep up? Only through tokenization.
Okay, great. So you've articulated very well the benefits of tokenization and what it is. But then let me ask you this. If it's such a clear case and clear benefits, why is tokenization already not mainstream? What are the key constraints that are stopping tokenization from happening tomorrow? The entire 700 trillion worth of assets on Earth that can be tokenized.
Well, I think there's a couple of different components. The first is, do you have the right regulatory oversights in order to create confidence to hit societal-wide scale? If you looked at what the ownership is of, say, Bitcoin, which is maybe the most widely owned asset that operates on a blockchain, it's quite significant. But it's still relatively small within the concept of money, within the concept of share ownership. And that's because you haven't created the right structures to be able to create mainstream adoption through mainstream distribution. Very hard, for instance, to go get crypto through a bank where almost everyone has their accounts or a broker. It can happen more and more, and in many markets it does, but it's still quite cumbersome. It's still not well understood, and that's an education issue as well. So I think there's the regulatory frameworks, there's the education, and that would in turn create the distribution mechanisms. But I think it's also important to recognize that tokenization is just a different database. No one talks about databases. No one goes, oh yes, I use a MongoDB as my centralized database. No one cares. No one cares, oh, I use a Linux database. It doesn't matter. It doesn't matter which blockchain you're on. It matters what problem you're solving. And so tokenization has to be able to solve problems in a scalable way, and it can't do that yet. The technology is still early. It doesn't mean that it won't. And if you even go back 10 years ago, how much has changed, it's enormous. And I think that can sometimes be lost. Well, why isn't it changing everybody's lives today? Well, these things take time. I mean, you don't go from 0 assets on a blockchain or 0 crypto assets in value, which is precisely where we were 10 years ago, to today we're at, I don't know, over $1 trillion, to being at 700 trillion. That's not going to happen instantaneously. It just can't. And I think there has to be some concept of, the internet took a long time to get adoption. Almost all technologies do. And that's a good thing because you have to work out a lot of the kinks, a lot of the issues that make it so that no one even understands that it's the technology that's making it work.
Got it. Okay, cool. I'd like to ask the audience a question, actually, because I noticed many of you are not paying attention. Guys, wake up. Don't look at your phones. Look at me now. Can I just have a show of hands? How many of you in the audience own gold, physical gold? Okay, actually not that many. And how many of you own Bitcoin? Wow. Okay, I guess this is a crypto panel, so probably not surprising. I want to ask you, Chad, about PaxG. So Paxos has tokenized gold. And like you said, your tokenized gold is worth half a bill right now in market cap. Yeah. Why did you decide to tokenize gold? What was the purpose of that? And why did you, tell us about why you did that.
Well, there's a couple reasons why gold, to me, is a logical asset to tokenize. The first is that it's a bearer asset, and there's a lot of reasons why people want to own it physically. And part of the reason why I think it hasn't been more widely adopted is because there's no good way to use it electronically. No one wants to take physical gold with them anywhere. It's just too hard, it's heavy, it's cumbersome, it's basically very analog.
Unless you live in India, of course. Those guys love it, man.
Yeah, exactly. Look, people who like physical cash like physical gold, don't get me wrong, I can understand that. But if you had a way to own physical gold in electronic form, you have changed it, you've tokenized it, which is what we do. So the way we operate our gold product is we hold gold in vaults in London, Brinks, HSBC, ICBC, they're holding gold in vaults in London, and each token that we issue relates to the serial number of the bar. So if you actually came to our website, you could type in the token that you have, and you can see the serial number that you have. And it's physical ownership that is moving when one person sends a token to somebody else. So this is really powerful. You've now created a bearer instrument that is electronic that relates to the physical instrument sitting in a vault. And you can imagine doing that not just for gold, but for any commodity, actually for securities, et cetera. It's the exact same process, even to tokenize dollars. And part of the reason why gold makes sense is it's one of the most liquid assets in the world. It trades hundreds of billions of dollars a day. It has one of the largest market caps. It's well over, I think, 12 trillion now or something. So it's actually the single largest asset in the world, asset class in the world. Obviously, equities are larger, but as a single asset, it's the biggest. And it's been historically widely utilized. It's also not highly regulated like a security. So that means that while our instrument itself, our tokenization, is a regulated product, it's regulated by the New York Department of Financial Services, the gold itself doesn't have a lot of other underlying regulators. So it creates a capacity to see how this works, be able to be nimble with the market, and to be able to drive adoption over time.
Got it, got it. Now, speaking of regulation, as you people may know, Paxos was recently hit by the SEC with a Wells notice. And I've got to congratulate you, Chad, because I think if you get hit by a Wells notice, it means you really made it in crypto. Coinbase got hit by a Wells notice, and of course, I'm sure that they would like to hit Ethereum with one, but they can't find the CEO because it's decentralized. Tell me, Tether and Circle are known to do a few shady things, but Paxos is pretty well regulated. Why did the SEC come after you? What was the deal there?
Well, the way we've tokenized assets and we're tokenizing dollars is trying to do it in a very specific way, which is that we hold the assets in our trust company, and that's bankruptcy remote and fully segregated. If Paxos fails, the assets are still there. No one's a general creditor of Paxos. And what we've also done is make sure that the reserves are firstly fully backed. And we've made sure that the reserves are held in instruments where there's no liquidity risk, there's no interest rate risk, there's no credit risk. You're only tokenizing a dollar. And if you're only tokenizing a dollar, to me, that is not a security. There's no yield. It is, and we certainly have spent a lot of time making sure that we
construct this in the right way. So why did the SEC come after you then? What was the deal?
I think the SEC over time is trying to look at not just stable coins, but all assets, and how can they create a regulatory purview over them. And we certainly don't think that stable coins make sense to be inside the purview for securities, because it's not. You certainly could offer a security by offering yield or doing other types of things, but you have to construct these in the right way. And we also make sure that we do it from a regulated entity. And if you're doing it through a regulated entity, you're creating oversight that is the equivalent of a securities regime. So the right oversight without creating a securities instrument, to me, is not a security. And that's the position that we've always had. And that's the standard that we've set from the very beginning when we launched the product.
I'm with you. And if you look at the Silicon Valley Bank situation, there was an issue there about duration mismatch and bonds and so on and so forth. Do you see Tether potentially experiencing some issues related to that, or is that not necessarily going to be the case?
Well, I think there's lots of ways to say something is worth a dollar. I think this is what we always come. This is the age-old story of banking. Is it a liability, or is it an asset that means you have a dollar? If you have a T-bill that matures in a couple days, or you have overnight repo that's over collateralized with treasuries, that's a dollar. It's going to be a dollar. It's a cash and cash equivalent. On the other hand, you could take a whole basket of loans, and you could say that's equal to a dollar too. And that's why you actually end up having so much regulation on banks, because you end up having a fractional system where there's dollars that you can have access to, but they're backed by long-dated loans where there's credit risk and interest rate risk, et cetera, and you put all these regulations in so that when someone goes to get their money back, they can theoretically get it. But the reality is you can never always, not everybody can get a dollar back. I think we all know this. It's a fractional system.
He's too polite to hammer a competitor even when I gave him the chance. It's cool though.
Well, the answer on any competitor is, how do you manage those reserves?
Right.
Are you fractionalizing them or not? And if you're not really clear about that, then there's always going to be a question: is that 90% backed? Is it 100% backed by cash and cash equivalents, or are you fractionalizing it? And I think when you're regulated like we are, you can answer that question very simply, as in, here it is, we know for certain. And when you're not regulated with a prudential regulator, you don't know.
Got it. One last question. We're kind of experiencing now a tension between the entire legacy financial system and an emerging class of disruptive technologies such as blockchain and crypto. And this tension is actually becoming visceral. You're starting to feel it now. How do you see this playing out? Do you feel that the traditional institutions like banks have a role to play, or do you think that we're on the cusp of a very significant disruption of the entire legacy financial infrastructure?
Well, I think we're certainly on track for big disruption in infrastructure. That does not necessarily mean disruption for banks. And I think that's a key point. It's one that we make all the time. Now, our customer base is enterprises. That's all we have. PayPal, Venmo, Interactive Brokers, MasterCard, Mercado Libre, Nubank. Nubank's a bank. Why? And we have other financial institutions that use us as well. Some of the largest institutions have partnered with us, Bank of America, Credit Suisse, SocGen. Why are they using us? Because we're updating the infrastructure for their products. All of these institutions have something in common, which is that they have the end user. They have the end consumer, the end business. And they also all rely on infrastructure providers. Those infrastructure providers are not allowing them to offer products that meet the needs that their consumers have. And so what we always tell these institutions is, we are here as an infrastructure provider so that you can offer new products or to update the products you already have to what your customers want. Cool. You have the end users.
Yeah.
If they don't offer new products to their end users, they might not have the end users. I think that's what it comes down to.
A call on banks to get involved and start adopting. I think that's all we have time for. So thank you very much, everyone, for joining us. Please give it up. Big respect for my homeboy, Chad Cascarilla. Looking forward to having you in the UAE soon. Amazing.